Welcome back. Still tuned into Chartbusters on CNBC-TV18. While the secondary market is seeing a lot of action, there's a lot of action in the primary market as well. So let's get to that. The guests on our show today are gentlemen from Rishabh Instruments. The company has launched their 491 crore rupee IPO today. The issue will be open for subscription till the 1st of September. We have with us in the studio Narendra Goliya, who is the chairman and managing director of the company, and Dineshkumar Musaleka, who is the group CEO. Gentlemen, thank you so much for joining us. It's a pleasure to have both of you with us in the studio. Well, you know, I was looking at the DRHP and I saw that you are into a lot of categories. For simplification, can you explain to our viewers what exactly is the product profile, which are the industries that you cater to, which is the biggest contributor to your EBITDA and profits?
Yeah. First of all, it's a pleasure to be in your studios and to talk about our company. It's always a pleasure to talk and about what we have been doing. And coming back to your specific question, that we have got at a large scale, we have got two businesses. One is the electrical side of it and the aluminum die casting side of it. Electrical instrumentation side, we have got 60% of our business, and about 40% is into aluminum die casting. In 60% business which we have them in electrical automation, which is about 10% of our business, and then we have got metering business, which is about 40% of our business, and then we have got test and measurement equipments, which is about 10% of our business. So this is how the entire portfolio is spread.
Okay, all right. Well, welcome, gentlemen, to our studios. You know, part of the stock market believes that maybe, in fact, valuation-wise, you're at the upper end, going by the trailing multiple, right? It's at around 30 to 35 times. But obviously, you see big scope for your business. That's why you'll believe that the pricing is right. So give us a couple of details there.
Yeah, that's correct. See, couple of things. You know, one thing is what the stock market sees is only what is declared by SEBI and what is in the RHP. But what has happened this year, we are coming with the IPO. So there was a very big ESOP given to the people. Obviously, you know, it has its own advantages. But that has brought down this thing. It's not a cash expense. If you remove that, the multiple will come down much lower.
Lovely.
The second most important thing which I would like to stress is that last year has been a year after COVID, and lot of raw materials, especially semiconductor. Our industry is highly dependent on semiconductor chips, and semiconductor prices went through the roof. There was a shortage. This has affected us. There was a Ukraine war. The energy prices. Energy used to be 3% of our turnover in Lumal. Alucast uses a lot of gas for melting. Every day we melt about 20,000 kilos of aluminium, so that uses gas, and the gas prices went from 3% of our turnover to 10% of our turnover.
Right.
And all this could not be passed on to the customers so fast. Our customers are large customers, you know, people like Value, people like Mali, people like Sandon. A lot of multinationals are there, and they have their own internal processes. This year it is much better. It is back to normal, and I'm sure in the future it will be normal unless some crisis like COVID or something comes up. But these are the main reasons.
All right. You know, that was what I wanted to ask you. Now, there are two parts that I'm trying to understand, right? You're going to use part of this money that you're raising for the company, 75 crores approximately. So what is your peak revenue potential? If you could help me out with that number. Post this capex, where can you go? Point number one. Point number two is margins have come down a little bit in the last few years. The top line growth has been great. So a rough margin band that you could give us.
So the one of the reasons which Mr. Narendra Goliya explained to you about in the last year, particularly when the top line went up and this has come down. So there were basically four reasons, two operational. One was raw material cost going up in electronics, and energy cost going up for aluminum die casting, which he explained, and also on the non-operational side, there are ESOPs and also currency fluctuation, because we have to consolidate. These were the two things. That's what has affected us. Otherwise, if you look at our historical last post-COVID data, we have been growing at about 22-23%. So that we see even bigger driver than what we had in last 2 years because of the.
So you expect margins to improve from here on, given that the input costs have fallen down. So we clear that out of the way. On listing, we'll want a specific number out there. Currently, you'll be in that silent place, so we don't want that. But we could tell us the peak revenue potential.
With the capacity that we have currently, we are utilizing about 50-60% of our capacity.
Okay.
And and there are some modules of production which have got bottleneck and which have got about 80% utilization now. This 75 crores which is coming, 62 of which is going into this capex in India. So that will address those two bottlenecks which we have about 80%.
So around 1,100 crores is what you can do
very easily
at peak level.
Yeah.
And that will be when the capacity is fully utilized, and that would be in how many years?
Yeah, it will be in about 3 to 4 years time.
3 to 4 years.
So our industry capacity never gets fully utilized because it's not a balanced line. There are some operations where you'll be at 80-90% capacity. Some operations will still be at average capacity will still be 60-65%. But overall, yes, 1,100 crores is absolutely a doable number.
Okay. So I just wanted one clarification when you said you cannot pass on your cost to customers. Are you entering into long-term contracts with your customers? How long they are? At what rate do you decide that we will pass on the price hikes? And because of whatever issues you saw in last 2-3 years, is that the reason your OCF was lower in last 2 years and it got impacted?
Yeah. See, first of all, this is very interesting question, and we have been working on that since. You always keep on learning. So, aluminum die casting, we have a long-term contracts. The contracts are typically from 4 to 8 years long-term. All of them are large global customers that we cater to, and we sign what is called as a long-term agreement, LTA, with plus minus 20%. So that's a long profile which we have. Say there are two major components which go into manufacturing of aluminum die casting. One is raw material, the LME, the aluminum alloys. So there we pass on every quarter the changes to the customer, so that we have been neutral. But energy prices have been stable before Ukraine war. So this was not in the equation. During this crisis, what we did was we are indexing the energy cost. So we sign a contract with the index of this energy cost, and then when the energy cost goes up or down, we do the price corrections to our customers. So that has been agreed, and all this it took some time for us to address the old contracts because they were watertight contracts. We had to renegotiate with the clients, and we did that. And also the new contracts, we are going on the same direction.
The customers are all long-term customers, but they are customers for long. So they do accept something beyond the contract, but it takes time. It's not something you do it today, tomorrow. So there was a time lag of 6 to 9 months before. They all accepted the new energy prices. May not be 100% of the increase. Meanwhile, of course, the prices also came down. So it's a very dynamic situation. But I think now everything is stable, and they accept that the war has created the problem. See, finally, they want to buy from you. They need suppliers, and we need customers.
Just quickly explain to me, why is it more towards exports? Your sales, I think, is more towards exports. Do you see that mix changing going ahead, or do you expect it to be in this ratio?
Yeah, it's if you look at 10 years ago, Rishabh was a 100 crore company. It was in India. There was a lot of acquisitions which took place. So in 2011, Lumel was bought, which was around 150 crores then. So that has grown to close to about 400 crores, and Rishabh has grown to about 190 crores. So there has been a growth domestic, as well as the acquisitions have also grown. So, and of course, we cater to the global market. We have got operations in UK, USA.
What is the ideal mix you'll be looking at, exports and domestic?
So if you look at ideal mix, we'll be looking at about 20. Today, we are about 20% in India as a market consumption. 80% is outside, but 40% of it is aluminum die casting, which is produced and supplied in Europe itself because of the heaviness of the material. So there's always a comfort zone where your markets are. So we have got some plans to expand those businesses, which we can't talk too much because of SEBI regulations here. So we will be looking at growing all the markets. USA and China also, we have got acquired companies or set up companies. So these are big market potentials because they are number one, number two economies.
Continuously, we look at organic and inorganic both. Organic is something which you can define, which you can control, which you can manage.
Yes,
inorganic happens when it happens. You try 3 inorganics, you get 0, or you may get 2, or you may get. So to that extent, really we can't decide what the ideal mix is, but we actually look at margins. If you're getting good margins in India, we'll do that. If you get good margins abroad, so that's our focus.
Well, gentlemen, thanks so much for coming down. That commentary is something that the street tracks very, very closely. On listing, we'll get your back
more
on.
details, of
and
course.
At that point of time, we'll want more numbers. But wish all the best, and we look forward to chatting up with you.
It was a pleasure talking to you.
Thank you so much. Great to be here.
All right.
Thank you. Thanks a lot.
Thank you so much.